Taxes will likely be one of your biggest expenses in retirement. But how do you figure out how much you're actually going to owe? And once you figure that out, how do you actually pay the IRS? By the end of this video, you'll understand the process we go through to estimate your tax bill in retirement each year. And if you're still wondering about the mechanics of how to actually get the money from you to the IRS, we'll cover the top 3 ways that successful retirees are handling this and explain when each option makes the most sense. Let's get started. So step 1 of this process is figuring out how much we're actually going to owe each and every year. So as a financial planner, we utilize a tax planning software to help clients estimate how much tax they're going to owe each year, because in retirement, things could look drastically different from one year to the next. Let's hop into a mock scenario to take a look at what that might look like. We're going to be running through the column titled Scenario 2, Estimated 2025 for today's purposes, and we're just going to walk down line by line and take a look at the different inputs that impact what your tax bill will be in each given year of retirement. So as we get started, we want to make sure that we're looking at the correct tax year. We've got it set for 2025. Each and every year, we see the income levels for each marginal income tax bracket tend to change a little bit, so you want to make sure that we have it set for the right tax year. Now let's jump to the income section. So as you can see, we're in retirement. We don't have any wages that are going to be taxed for this year. As we continue to scroll down, the first line item we see a value in is taxable interest. So in this scenario, we're expecting to have about $5,000 of taxable interest for the year. The next item that we see is qualified dividends and then total dividends. So to be clear, this qualified dividends number is inside of the $5,000 number of total dividends that we're looking at. The next item on our list is IRA distributions. So you can see for this scenario, we're looking at $90,000 of IRA distributions. In all likelihood, this is probably being paid out in the form of a monthly distribution. As we continue scrolling, we can see we have the gross Social Security listed here. So in this scenario, we have $70,000 of Social Security coming in. Obviously, this would be for a couple married filing jointly to get up to that dollar amount of Social Security benefit. We'll be looking at 2 different Social Security payments combined. And what you'll notice on the next line down is that of that $70,000 of Social Security being paid, only $59,500 is taxable. So only up to 85% of your total Social Security payment is taxable. These folks fall into that category, so that $59,500 is what's going to be taxable to them. As we continue down, we can see we have $25,000 of long-term capital gains that we're planning on for this year, so we want to make sure that that's accounted for. And as we get to the bottom, we now see we have $184,500 of total income expected for the year. So from there, we can start looking at our deductions. So for 2025, we have a $30,000 standard deduction that we'll be able to take. So we'll take that. That brings our taxable income down to $154,500, which leaves us with an expected tax due of just shy of $22,000. So again, we realize that you might not have this tax planning software available to you. If this is something that feels a little bit over your head, reach out to your CPA, to your financial planner, and they'll be able to dive into what each year should look like based on the inputs that you give them to put into the software. So now that we know what income is coming in the year 2025 for our estimate, the next thing we want to go ahead and take a look at is how much do we need to pay in to avoid any underpayment penalties. So where we're going to see that is on this tax report, we have the 2025 safe harbor amount. And in our scenario, what that dollar amount is going to be is $19,735. What that is 90% of the estimated tax that we have for the year. So we need to make sure that if we're going to have a tax liability due of $21,928, we need to pay in at least 90% of what that final tax bill is going to be in order to avoid an underpayment penalty from the IRS. There's also a second safe harbor calculation that's available where if you pay in at least 100% of what you paid in last year or 110% if you're a high income earner, that can also satisfy that safe harbor as well. But for these purposes today, we're looking at the 2025 safe harbor amount of $19,735, which is 90% of what we're expecting to owe at the end of the day. So this is our target. This is what we want to make sure that we have paid in by the end of the 2025 calendar year. So the next question, and where we're going to spend the bulk of our time today, is the mechanics of how we actually get that dollar amount from you to the IRS. So if we take a step back, in your working years, if you were a W-2 employee, every time you got your paycheck, whether it was monthly or every 2 weeks, as you know, a portion of that paycheck was withheld from you, and your employer took those dollars and sent them to the IRS on your behalf. At the end of the year, you were given tax forms and you looked at that W-2 and you said, okay, of the X amount of dollars that I earned this year, Y amount of dollars was withheld from me and sent to the IRS for me. And so when you take what you actually owe at the end of the year as calculated by your CPA, and then compare that to what your employer sent to the IRS on your behalf throughout the year, there was a difference between those two numbers. And then what that difference was either your tax return or how much you needed to pay in addition to what you had already withheld. So now as we enter retirement, we don't have an employer withholding from our paycheck. We don't have a paycheck for that matter. So the question becomes, how do we pay taxes in retirement when we don't have a paycheck that's having taxes withheld for us? And that's where we're going to spend the bulk of our time today. So here are the top 3 ways that we see retirees successfully paying their taxes in retirement. So number 1, the first way we see retirees paying their taxes is via quarterly estimated payments. Now, I wanted to start it off with the option that's the biggest pain and the one, honestly, that we try to avoid for our clients as much as we can. But quarterly estimated payments are when you're using your own dollars from your checking account, for example, to make payments on a quarterly basis. The first thing I want to point out is that the due dates are kind of awkward. So they're not your traditional calendar quarters. The due dates are April 15th, June 15th, September 15th, and then January 15th. So if you do fall into the category of needing to make quarterly estimated payments, make sure you're real aware of those dates because it isn't natural or what you might think it would be. And then the next thing that we look at is, well, how do we actually get the dollars from you to the IRS? There's 2 main ways to do it. I certainly prefer the first. And the first one is to use IRS Direct Pay to make electronic payments. So the way to do this is to go to irs.gov/payments, and this will direct you to a screen where you get to pick, am I paying my personal taxes or business taxes? So if we go ahead and click on pay individual tax, this allows us to then come to the screen for individual taxpayers where we can now make a payment. Now, I won't be able to walk you all the way through, but when we start looking at the direct pay site, really, it's pretty straightforward. So the first thing we're going to want to do is look at the reason for payment and go down to estimated tax. And then we want to go ahead and apply this to our 1040-ES. That's the tax form that we're using to make these estimated payments. And then we want to apply it for the year that is required. So in this case, we're looking at 2025 and hit continue. The next thing it's going to ask you to do is to verify your identity. So I'm not going to walk us through any further here, but basically what they're going to want to do is look at information from prior tax returns that you have filed to verify that you're making this payment for yourself and these taxes that you're sending get credited to the right person. Now, if you're a little bit more old school, you still do have the option to mail in your payment. So that's going to be on the form 1040-ES. So same thing as we were looking on the digital version online, but you can go online again to the IRS website and print off this form and then mail it in. We'll have 4 payment vouchers. So really all basic information, fill out these vouchers, put the dollar amount that you need to pay in the top right corner, cut out the vouchers and mail them in along with a check payable to the United States Treasury. And this is the old school way of making sure that you get your taxes paid via quarterly estimated payments. Again, this is the biggest pain because you have to remember these awkward dates and then you have to physically go do it 4 times a year. So in our view, I'd love to automate this process. That isn't possible via estimated payments, but sometimes that's our only option. So moving on to the second option that we have for paying taxes in retirement, what we're going to look at now is withholding from reoccurring income. And there's really 3 different types of income that fall into this category. The first one is pensions. So if you receive a pension from an employer, so this is a monthly payment that more than likely gets directly deposited into your bank account, more than likely you're going to have the option to contact your employer or the company that they have contracted out to manage their pension on their behalf and ask them to do withholding for you. Really, this is a great way to automate your payments, and it has the feel very much like when you were working. And so if you were entitled to, let's call it $3,000 a month, instead of receiving that $3,000 a month of payment, you could elect to have them withhold 10%, for example, and that $300 would then be sent to the IRS on your behalf, leaving you the net amount of $2,700 each month. Same thing with an annuity. Really, they're pretty similar. The concept is similar. I went and pulled a form from Nationwide, who is a common insurance company that offers annuity contracts. As you can see here, part 5 of this form allows you to elect how much tax withholding you want from each one of your payments. So their default is to withhold 10% on your behalf, but you do have the ability to change that percentage if you fill out a form. And so if you find yourself in a position where you don't have enough tax being withheld, another tool in your toolkit, if you are someone who receives income from an annuity on a monthly basis, is to have them pay some of that or send some of that to the IRS on your behalf. Once again, you're going to receive a smaller net amount on a monthly basis, but come end of the year, you're going to be caught up on your taxes. And then the last reoccurring payment that we use all the time for clients is to have the withholding done from your Social Security. Now, having federal income tax withheld from your Social Security is super basic. All you have to do is go online, download form W4V, and again, same concept. The Social Security Administration will send dollars to the IRS on your behalf. One limitation we do have when we use Social Security for withholding is that we're limited to only 7%, 10%, 12, or 22 as our options for how much we want withheld. So we have a little bit more flexibility most of the time with different withholding options. If we're going to withhold it from our Social Security, they want us to pick from one of these 4. Or 0%. 0% is always an option as well. So go online, print off this form, calculate how much you need withheld, mail it in to the Social Security Administration, and you're all set on your Social Security withholding. We've made it to our final way that you have available to you to pay taxes in retirement, and that is withholding from retirement accounts. So in our example that we looked at earlier, these folks were having $90,000 of income come to them from their IRA in retirement. One of the options that you have available is that you can have your custodian send dollars to the IRS on your behalf, the same way you had it happen from your paycheck when you were still working. Most of the time it's a form, or talk to your financial advisor, whoever's managing that account on your behalf, and they're able to set up withholding on both the federal level and most of the time the state level as well if you're subject to state taxes. What I love about this option is we can automate it. So we can have this happen to you on a reoccurring basis along with your monthly income, and we can have this set up so that we hit that target by the end of the year. Additionally, if you take out any one-time lump sum types of withdrawals from those accounts throughout the year, we have flexibility in how we can withhold for taxes for those as well. So a lot of times, if we take a large lump sum in addition to monthly income throughout the year, that might bump us up into that next tax bracket. We have the ability to withhold maybe a higher percentage on that specific withdrawal because we know that it's going to take a little bit extra taxes in order to get us where we need to be at the end of the year. So those are the big 3. Quarterly estimated payments, they're a pain, but they get the job done. Withholding from our monthly income is the second option. And then also having withholding done from retirement accounts. Those are the 3 ways that we most commonly see retirees paying their taxes in retirement. Again, our preference is if we can automate it in any way and make life easy for you, that's our goal. If you have more questions on how to pay taxes in retirement, or your situation is maybe a little bit more complex and you feel like you can't handle it on your own and want a CFP to build your own personal financial plan, click the link down below in the description. You'll have full access to my calendar. I'd love to talk with you about what that might look like.